Good afternoon, good evening, good morning, everyone. This is Joseph Trevisani from Worldwide Markets. Today we're going to look at the oddity, which all the central bankers are much in love with, of interest rates and what it means for us in the currency world. The euro is the first major currency to have, through the ECB, to have initiated this oddity. There are other various central banks around the world that are now participating. The Japanese did. It gave them a big surprise when things didn't happen as they thought they should. The same is true for the ECB and its reaction. But before we do that, what I'd like to do is take this step by step. So first, I'm going to look at why are we here? To say the very least, that interest rates and negative interest rates are an oddity in the history of central bank rate policy. I would go as far to say they are an oddity in the history of the world. Oh, by the way, as I say every time, if anyone has any comments or criticisms or anything they'd like to add to the conversation, please put it right into the chat box and I will answer them. I don't mind at all taking time out from my disquisition to answer any questions. I always prefer to take this more as a colloquium than a lecture, as I've said many times in the past. So I would venture to say that negative interest rates, our current fascination of the central bank, financial, and commentariat world are probably never happened before in the history of finance. And I'm talking finance back to whenever people started first charging interest. And I don't know when that was, but it was a long, long time ago. Logically, negative interest rates in the real world don't make a lot of sense. It is only in the central bank world, in the theoretical central bank world, that is the central bank world that gets its ideas and its logic from economic and academic equations, that interest rates have this continuum which extends over into, of course, logically, I know I talk about my kids all the time, but they are just starting to understand negative numbers. There's 7. And you can't explain negative numbers in reference to the real world, except maybe in reference to the artificial scale that we put on temperature. But there's no reason to have an arbitrary point of 0 where water freezes on both on the Celsius scale at 0 and on the Fahrenheit scale at 32. That's the only way that negative numbers make any sense. In the mathematical world, they make perfect sense. They're, in fact, a necessary item for many types of mathematics, most, I would say. But in the real world, they don't make a lot of sense. You could start temperature gauge at absolute 0 at 0, and every other temperature would be higher. That might make more intuitive sense, perhaps. But at any rate, so interest rates at a negative value are designed to foster greater asset growth. They're designed to force banks and everyone else to spend money. That's what they're designed for. Either to spend money on assets, on financial assets, on hard assets, on new players. I mean, new DVD players. Does anybody use DVDs anymore? Probably not. On new LCD players. Anything you'd like. They're designed to foster money movement in the economy. That's what they're for. What we have found is that they tend to do, surprisingly, the opposite. But Let's go back and take a look at why we are at this juncture in central bank rate policy. And of course, we'll start that with what is going on in the ECB. I am not going to do so much about what's on in the US. There's simply too much material to cover. Okay, so let's start with the first ECB. Okay, there we go. This is inflation, headline inflation we call it in the United States. The ECB looks at headline inflation. The Fed chooses core PCE. For my mind, you might as well look at headline inflation because what you're really talking about is its effect and predictive ability for consumption. And that is headline inflation. It's not the core inflation. I mean, it's great for the Fed when the Fed says that we don't really have much inflation, or we have too much inflation, when they discount food prices. I mean, that never made a lot of sense to me. It ends to be, I mean, I understand the logic behind it, but since you're attempting to affect behavior in the real world, that is the world of people, you and me who are buying things and everyone else who's making economic and consumption decisions, what matters is the headline inflation rate. Now, what can we see of this chart? Quite obviously, and this is not the only chart that looks like this, but then we're going to talk about to begin with. Year-to-year inflation in the ECB, in the EMU, has been, as someone else might say, on a downward splurge since 2011. And in fact, the 2009 to 2011 rise is largely a base effect because it was falling so hard back in 2008 and 2009. So the direction is this way. It is down from 3% in 2011, but even say 2012, we're talking 2%, which was the last time that it was near or at the ECB's target, just like the Fed, down to here and dropping again. This is not oil prices. I don't have a chart of oil prices. As I said, there's just too much information. But we all know what oil prices have done. And oil prices have gone down over here. From about the summer of 2014, they've been down very substantially, but not from here. So the downward movement in inflation. Now let's take a look at another one. I just want to find a longer chart here. Where's my long chart? Sorry, folks, when you get all these charts up here, you have to take a bit of time to find the right one. Sorry. Here we go. Okay, this is a longer chart, although it has some other information on it. It's the one I want to use for the moment. Okay, so this is a chart I'm going to deal with in its entirety later. But it is, if you look at the white line, that is ECB EMU year-on-year inflation. And the yellow line is US inflation. And if there is one thing that is a constant, it is that, I think I have a longer chart here that I'll take a look at in a second, but that is the downward movement in inflation rates, certainly since 2008. But when you run a longer chart, as I will right here, hang on. Let's see if this is the one. No, it's 2007, it's not the one. You know, because the ECB is only been working since about 1999, I didn't put up any of the long-term charts, but here we go. We'll take a look at the US one. Okay. Okay, oh no, this has the information on it, sorry. Okay, so these are sort of a proxy for long-term interest rates. I'm using the 2-year rate from both the US and Germany. And this approximates the movement in the CPI. And what have we seen? Since 1990, and actually, as we know, because we've covered this in many other webinars, worldwide inflation rates have been declining since about 1984. Uniformly, all the patterns look the same. There are lots of blips. You get oddities, you get emerging markets in other countries with differing patterns. But the main developed nations' inflation rates and their main interest rate, which is what this chart is, although this is the German 2-year, the US 2-year, the Federal Reserve Fed funds rate, and the Euro main refinance rate, which only goes back to like 1997, have been declining. So what the ECB on the simple inflation and the Fed on the simple inflation side is fighting is a long-term trend. Some of the, and this is important because the ECB and the Fed are both sort of pretending, and they must have private doubts about this, that, let me just pull up the chat here. Hold on. They're pretending two things. That here's the chat. Okay. I just wanted to check the chat. One, that the dip below 2 pretty steadily here, and is largely a function of the effect on prices of the financial collapse and recession and the recovery. And two, they're pretending that interest rates are an effective counter to this. Now, interest rates being an effective counter below the zero bound or near the zero bound are simply a logical extension of central bank interest rate policy. If, it's linear thinking. If interest rates if a move in interest rates from 3 to 2 has this effect on the economy, and we've established this, it's empirical, then a move from 0.5 to 0 will have a concomitant effect. And what we found out, of course, empirically is that is not true. But that's another story. So the interest rate or the inflation rate that the ECB is trying to affect, and I'm dealing more on the ECB side with this than I am on the Fed side, but let's take a look back to the inflation rate, okay? So we've seen the inflation rate is here. Again, long-term trend that the ECB is trying to affect. So let's look at some of the other statistics from the ECB, give you an idea of what the ECB is attempting to deal with in all of their, okay, this is GDP. They measure it differently, of course, but this is GDP year on year in the ECB. In the EMU. Again, nothing spectacular, lower than the averages going back 20 years, but concerning. Let's look at, hold on, let's get this one here. Retail sales. Probably not quite as emblematic of their concerns as it is in the United States. Nevertheless, similar types of economic statistics coming out of the EMU. EMU's primary worry and the ECB's primary worry, which is the one they go on and on about at every press conference, is the inflation rate. It's not this, it's not retail sales, it's not even GDP. It's the inflation rate. So let's see what effect and what relationship there has been between the inflation rate in the ECB and their attempts to deal with it. Well, let's just show you one more here. This is the, again, not the kind of concern it has here in the States, but still a problem. This is the unemployment rate in the ECB, in the EMU, which is the white line, and the German unemployment rate, which is the yellow line. This chart has a fair amount to do with some of the political problems throughout the EMU now. If you compare this, and I didn't put that up there because I'm primarily talking about the ECB and the EMU today. If you compare this to the unemployment rate in the United States, you can see a great disparity. Ours rises faster and comes down faster and ends at a lower rate than the European. I mean, 10.3, and now ours is actually higher. If we counted the Americans higher, if we counted our unemployment rate the way they do, it would probably be about 7% rather than 4.9 or 5. Nonetheless, it's still considerably lower. But because of the different nature of the political systems and their social services and social net, as it's called in Europe, this unemployment is less of a problem, or at least it's less of a concern for the central bank. Plus, the central bank does not have a specific employment economic growth mandate as the central bank does here in the United States. So they're a little more free to ignore some of those things as opposed to they are here, where they have to, where the head of the Fed has to go before Congress twice a year and questioned by the legislators about why the economy is not growing and all sorts of other things. Okay. Now let us return to the topic. Okay, so this is here. Here we go. Okay. The ECB's main concern in the EMU has been inflation more than anything else. That's what Mr. Draghi spent almost whole press conference talking about after last Thursday's meeting. And so what are the effects of central bank rate policy historically? I'm not talking about what should happen. Remember, the Fed has been predicting inflation is going to recover forever. It just has a little bit lately. And it had almost no reference to what's going on with the central bank interest rates. So here we have a chart going back to 2006, deliberately, but just before the financial crash. One thing that I think central banks are having a very difficult time with, both theoretically and practically, is that the relationship prior between interest rates and inflation seems to have broken down. There seem to be other factors that are intervening and preventing the type of linear response to a change in interest rates, and a big change in, and a prolonged change in interest rates from what would have happened in the past. When Alan Greenspan lowered rates after the after the dot-com bubble burst, and then after the 9/11 attacks, what was the result? Well, the result was an asset boom, primarily in housing, but there was a reaction, a linear reaction to what you would expect. We have not really seen anything like that except in the equity markets. And the issue from the equity markets is more an issue of quantitative easing than it is interest rates. But here is the relationship that we're going to focus on between inflation, The white line is ECB inflation. The yellow, EMU inflation, I'm sorry, I keep transposing those two, too many E's here. The yellow line is US year-over-year inflation. I'm using the same type of inflation measure, at least category, as the ECB is using for this. That's headline inflation. Green line, Fed funds. Purple line, ECB main refi. And the striking thing about this chart is there's no relation. There is no relation between a 6-year run of low interest rates from the central banks and inflation rates. The logical question to ask, which I'll only mention now and then we'll talk about a little bit in a few minutes, as they might have said in the Terminator movies, Skynet is a neural network, a learning computer. Is somebody not learning something here? But let's go back. So what we've seen from the peak of inflation here in the middle of 2011, just following the ECB, because the Fed rates have been static for 6.5 years now, since the almost 6.5 years, since the very end of 2008. So we have 1, 2, 3, 4, 5. Wait a minute. 1, 2, 3, 4, 5, 6, 7, and a little more years for zero rates in the U.S. The ECB started lowering in its last batch in the middle of 2011. Since then, it has tracked, if you'll put it, inflation rate in the ECB down. This is not what's supposed to happen. There are either two possibilities here. Probably the two are combined. One is the relationship's completely broken down, which I don't think is true. There is something, the more likely reason is that there is something else intervening in the monetarist equation that is far more powerful than the change in money supply. It's also possible, and the banks have talked, and the central banks and many others have spoken about this, that the mechanism, ECB talks about this quite a bit, that the mechanism for dragging the increase in monetary supply or credit or whatever you'd like that's available out into the economy where it has an effect is broken down. I don't think the problem is a breakdown of the mechanism. I think the problem is a lack of demand. And so if there isn't loan demand, there is in fact no multiplication of credit through the credit system, and the ECB and the Fed can do anything they want. And if nobody is buying, then you get no effect and you get no movement and you get no effect on inflation. Okay, so there we have an empirical note. If we're going to talk about interest rates and the ECB and the Fed and their currencies, it is not, in my mind, sufficient to look at your equations, assume the relationships are unchanged, and continue with policy. The assumptions that are behind this are being questioned by the data that we're looking at. What do we have here? We have actually one rise. This is interesting. Right here at this end of the chart, we have the Fed half a point or 25%, 25 basis point rate hike back in December. And we have an almost identical in time, just a little bit before, increase in the US headline CPI rate. In Europe, we have an interesting move that's not supposed to be there. We have a mimic, but in the wrong direction, and one which is not acceptable to the logic of monetarist policy. And that is that the ECB lowered rates, not very much, but they did. And the inflation rate in Europe and in the EMU has gone down. So maybe what we're looking at here is a new relationship where interest rates now dictate the direction of the inflation rate. Instead of it being counter-cyclical, as I've always known, or having a counter effect. So if you raise rates, you get a lower inflation rate. If you lower rates, you get a higher inflation rate, which is the historical one that we've all grown to know, and if not love, at least accept. So now we have a new one. I'm joking, of course, on this. And that is, if you raise your interest rates, you're going to get a higher inflation rate. And if you lower your rates, you're going to get a lower inflation rate. If that's true, and I don't think that actually is, then we are in a world, along with Alice, which works by different principles. And we'd better discover those principles pretty soon, or we're going to be in a lot of trouble. Anyway, I don't think that's the case. So we have seen that inflation rates empirically so far. Maybe what we're seeing back here, down at this end, at least on the US side, is a return to the more historical relationship, or the only historical relationship, really, between interest rates and inflation. The monetarist inflation is always and everywhere a monetary phenomenon description of the relationship between interest rates and inflation. Let's try another story. And this is also part of the central bank deal. Okay. I have on my downtown New York outfit. I'm almost all dressed in dark colors. You know, it's part of my world. We work out here. Our office is out here in New Jersey, in northern New Jersey, Bergen County, a lovely area. And I live in Manhattan, so I do the reverse commute every day. Okay, this is central bank monetary policy by any other means. Quantitative easing, as practiced in various places around the world, is a new term. It doesn't mean anything different than interest rate manipulation. That's exactly what it is. It has a slightly, at least in the United States, not quite admittedly so in Europe, a slightly different ancillary purpose. That was the inflation of asset markets to provide the wealth effect. I think if we've seen anything, it's that the wealth effect is minimal to non-existent. It does not propel economies to greater growth. Otherwise, we would kind of have greater growth. This is a proxy I'm using for quantitative easing. I could put up a chart, and I've done this in the past, but it tends to be a little confusing. A chart of a particular asset, be it the euro or anything else, with quantitative easing dates in the United States and Europe and amounts. But you end up with a lot of dates, and you don't get a real sense of it. This is a much more concise depiction of what's going on. So here we have central bank assets, the balance sheet of central banks. The more QE they do, the more assets they have. It also has inflation rates, the European, EMU, and the United States. And let's take a look at the relationship. It seems quite obvious that we have to kind of ignore, you can't run this back very far because there's really kind of no relationship, because the central banks did not consider or use or probably even conceive, although maybe Mr. Bernanke had been conceiving it for a long time, since I believe he wrote his PhD on monetary policy during the Depression and the mistakes that the American Fed made. So who knows how long this idea was germinating in the chairman's mind. But certainly since 2008. Let me just check chats here. Yes, I don't think we're going to go back to barter, but who knows? I'm going to have to grow some rhubarb in my garden or something like that, so I'll have something to barter. Green here is the Fed, total assets. Purple, ECB. Yellow line, US CPI. White line, European, EMU CPI. Again, we have the same type of relationship. As a matter of fact, what we're really doing here is looking for a relationship. I'm not going to assume, as I jokingly did looking at the interest rates, that we now have a linear direct relationship, not an inverse relationship, but a direct one. Fed lowers rates, CPI goes lower. ECB lowers rates, European CPI goes lower. I'm not going to assume that, but we have from 2012 with this dramatic and historical rise in Fed assets, the various QE programs buying asset backs, now buying treasuries. You could look at this. I should have brought this. I mean, I could have brought the same charts from Japan. And I didn't for two reasons. One, they're depressing. And two, I think that the central banks around the world, except for the Japanese, actually including the Japanese, have been ignoring the evidence that is as blatant and as obvious as can be. That, as I said in last week's webinar, when you enter the negative interest rate world, or the very low interest rate world, you are changing from Newtonian physics to quantum physics. And the relationships are thereby different. Now, I kind of used that analogy quite a bit last week, but I'm not going to really dwell upon it this week, but I think it's an accurate description. And I think the evidence for this has been before all of us and before all the central banks for at least 10 years in the effects in Japan, on what has actually happened in Japan under these types of policies. They don't work essentially as it's been expected. So what do we have here? From 2012, the end of 2012 until, let's shake it, 2014. So 2 years of steadily rising Fed involvement in the economy. I mean, if you put on the chart of the Dow or the NASDAQ or the S&P 500 here, you know what you're going to see. So again, there is no question that the central bank rate policies, both interest rates, but primarily quantitative easing, have a very profound effect on the economy, on markets. There's far less evidence, and I would say almost negligible evidence, that they have any effect on the economy. But just to focus on interest rates, this Fed assets, the yellow line, is US inflation, headline inflation. It certainly does not appear, from anything I can see on this chart, that the Fed's incessant predictions that inflation is just around the corner, or the next corner, or the corner after that, has any basis in empirical reality. I'm not sure what this is right here, and I'm not sure anybody else is either. It is true that US CPI is more driven by rent costs than PCE, which is one reason the Fed uses PCE rather than CPI. I wanted to match up the CPI in the United States with the CPI in Europe. There is a rise in the PCE during this period as well, but it's considerably less than that. So Looking at these charts, it's difficult to make the case that the relationship that exists prior and in other areas maintains itself between interest rates, or the money supply, if you want, and inflation. The question we have to ask, of course, is one we've asked many times before, but I think it's as pertinent a question as there is in the discussion of this policy and central bank involvement in the economy. And it's a question almost never gets asked. If empirically, not based on equations that say certain things are supposed to happen, but if empirically, how does science test theories? I'm going to deal with that in a second. We're going to move on to the effect on the currencies. And it's very difficult, but that's where we're going with this. I'm going to do a little bit more here on the background, and then we're going to go talk about its possible effect and some of the effects on currencies, primarily the euro right now, because after all, that's what we're all involved in, the currency markets. If we're looking at policies that do not have the empirical effect, the question which never seems to get asked in the media or anywhere else is, why are we continuing with the same policies? If we know that they haven't had the effect, are we dealing with the wrong policies, perhaps? The reason this doesn't get asked is twofold. One, central banks are prone to act, and they're enjoined to act, and they're asked to act, and they expect themselves to act. The range of central bank policies is hugely limited. It's basically one effect: interest rates. The possibility, and I'm just going to throw this out here because I certainly don't have any proof of it and I'm not an economist, but it is quite possible, and in my mind somewhat likely, or likely, let's just go with it, likely, that the effect of interest rates that at these levels, and forced even lower by quantitative easing, on economies is exactly as interest rate policy since the financial crisis has been to repress interest rates, interest rate repression, get it lower because it's going to have an effect. What we've seen empirically is telling us, although I can't establish the connections, I could actually, logically, but I can't put it into an equation. They also counter to what's expected, counter to the predictions of equations. They also act as a repressive, as a drug on the general economy. The logic behind that being quite simple. Economies are driven by the decisions of people forming businesses, investing, to make money. One factor that's very strong founding a business is the cost of capital. Most small businesses fail because they mismeasure their cash flow. They run out of money. It's because their idea is necessarily bad, or even because their production is bad. It's because they run out of money. They mismeasure cash flow. One of the things that's important for cash flow, and a credit line, of course, is how much does capital cost? If you're forming a business and the 2-year is 0.75%, you know that sooner or later that's going up. You can't judge whether your idea is terribly successful or will be successful if you don't know how much you're going to pay for money in 2 years or 3 years. After all, you're not planning on staying in business for 6 months. You're planning on staying in business for 10 years or more, or passing it on to your children or to shareholders, whoever it is. So the decisions that might be made, the businesses that might be formed, the hiring that might take place. And yes, I disagree with some of the numbers. I don't disagree with them. I just don't think the employment numbers are giving you an accurate picture. First of all, the American employment numbers are highly seasonally adjusted. And second, they count many things as jobs, which should be counted as half a job or something like that. Primarily the part-time jobs, the low-paying jobs, and things like that. But at any rate, the effect on the economy of low interest rates, empirically, looking at the factors that we have in front of us on inflation rates. But remember, inflation is driven by two factors. And one of the more important factors that we've seen right now is demand. So if financial repression of the cost of money, of interest rates, acts as an economic repressant, then it's also going to act as a repressant on inflation, because it will depress the demand side. And you've seen a lot of this commentary. I mean, one of the Fed's primary logical economic justifications was the output gap. Well, what is the output gap if nothing except the demand gap? That's exactly what it is. So they're saying, in fact, that there is a demand gap. Not enough people out there buying products, so prices are not going up. But the next step in the logic is to say, well, why is there a demand gap? What could be causing that? We're assuming that the consumer, which is what you're talking about when there's a demand gap, is a creature of rote and linear habits. And I don't know anyone who is a creature of rote and linear habits. When things change, people change. They change their decisions, they change their spending patterns, they wait. Another example. The way one seems to have flabbergasted so many central bankers, and I don't understand why. They lower interest rates. They keep them low forever. They expect people to start spending with abandon, and they don't. I mentioned this one last week as well. Well, what happens? Sometimes, and it's been the case, the savings rate goes up. Now, why would people save more when interest rates are so low? And the answer is fairly obvious. If you are hoping to save a certain amount from your income, as many of us do, weekly, there are two components to that. One, if you're earning a certain amount because you want to have a certain amount when you retire, or you're saving for some near or far goal, as you put money into your business, really elementary stuff. I mean, my girls are just about there, and they're 7. You put money in the bank. That money earns interest, so you have that much more money. You can count that into what's available in 5 years for your spending project, whatever it is. Well, if you're not earning any interest, what happens? You still have to spend that same amount of money, or hope to, in 5 years. Where does the extra come from? Well, it comes from you. You make it up by putting more money into your account. So that's why the logic on the central bank side needs to be updated, shall we say, with some empirical studies. Okay. Now, for the last 15 minutes here, so we've seen that the policy impact of this wonderful new world of negative interest rates has almost no logic to the idea that if a 0.5% interest rate works, then a negative 2.25 is going to work, or a negative 0.4. There is nothing that supports that analysis that I've seen from the results. And remember, this is the first real time that there has been a prolonged bout of interest rates around the world that low that haven't had any effect. So the logic, the central bank logic, that if zero works not at all for promoting inflation and economic growth, then negative 0.25 is suddenly going to start working. I just don't see this. I don't see it logically. I don't see it empirically. How does science test theories? They make theories. Conjecture, ideas about what some particular phenomenon, what may be causing some particular phenomenon. And what do? They go out and test the theory against reality, against fact, against empiricism. If the theory correctly predicts events in the real world, then the theory has validity. If the theory does not, then the theory is discarded. And I wonder if we are not approaching this, I'm not some iconoclastic, very smart person who just figured this out. This is evident to everybody, including everybody in the central banks, that there may have to be a revision. Now, the revision in the theories are not going to come from central banks, it's going to come from somebody in academia. Nonetheless, we are at a point where the economic equations are no longer functioning in what they predict to happen from a change in inflation rates. I mean, a change in interest rates. And remember that quantitative easing is nothing more than interest rate policy by another name. Okay, so on the theoretical side, we've seen that there isn't a lot of connection. So now let's move to the euro and what we're seeing. Okay, now let's go to an actual euro. Okay, this is the I sent out a tweet. This is last week's Thursday central bank ECB party. Adinda, I'm assuming I run till noon here in New York. That will be another 12 minutes. If that's not the case, can you let me know so I can judge a little bit differently on how much I'm going to say here? Let me just check this. Okay, you just look at here. Now we're going to talk about some of the questions that are here about long-term rates, what is driving the currencies, how difficult it is to judge, and I agree with that, and where the dust is likely to settle. This is the wonderful reaction. You have to love this, unless you were, I mean, this is an incredible whipsaw in the markets from the Fed, from the ECB rate policy moves on last Thursday. It's interesting that the substantive moves of the ECB, of Mario Draghi and his companions, colleagues on the governing council, were entirely discounted by one comment. And of course, we all know what happened. The ECB announced their policies. The euro fell from here, which is about 1.975, if I remember, all the way down to 1.8021, I think. Then in the press conference, Mr. Draghi said that this they're probably not going to do anymore. Wham! And we haven't looked back since then. What is this telling us? It cannot be. I mean, I set out sort of a cynical tweet last week when I watched this happen. And I said that Mr. Draghi could not have wanted this, because what happens when you have a stronger euro? Well, you get deflationary factors into the economy, of course. Imported goods are cheaper, oil is cheaper. That's a deflationary impact. This cannot be what Mr. Draghi wanted. But I said he could have called Mr. Kuroda at the BOJ, who said, watch out, because that's exactly what happened to the BOJ. The linear relationship that's expected is not functioning here. We're in the quantum world of zero rates. The euro went up 4 figures on his comment. But the thing that is so unusual about this is that nothing here related to, except the ECB comment, to U.S. policy. Now, for the euro, of course, we're only talking about two different rate policies, the United States and the European Monetary Union, the EMU and the Fed, ECB and the Fed. Nothing about this move changed Fed policy, of course. Right now, the only expected move in the Fed that's above 50% for the next 0.25 rate increase is December. It is, and was this morning, and will be this afternoon, March, the end of the first quarter. Markets are not expecting a rate increase. And I actually listened to I think the economist, the chief economist for, I think, Morgan Stanley, a woman named Ellen Zentner on the radio on the way in. And she was very, very clear and very, very precise about the logic behind this. But the markets are not expecting a Fed rate increase at any greater than 50% probability until December. Certainly not this week on the 16th. The Fed meeting after that is the 26th and 27th of April, but that's not a press conference meeting. Unless they come out and announce a press conference, unlikely there'll be a rate increase. The next one is June, the beginning of the summer. It's a possibility. The one after that is September, and the one after that is December. So none of that has changed. But the comment, now this move on Thursday was, of course, a combination. It wasn't simply that Mario Draghi said we're not going to do anything else. It was that, of course, hit off a huge short squeeze in the currency. And you had a standard, typical, heroic stop run up in the euro. Once it got rolling, it took off, because since then the euro's been on a downward path, which frankly makes more sense if you think about it, because the accumulating impact of this policy is one of a weaker euro, especially when contrasted to the continuing strengthening policies in the Fed. So let's see if we have anything on the technical side here. So the long-term view, which I think will reassert itself, and right now, tomorrow, there's essentially nothing out in the United States. The ECB has now told us what their policy is going to be. Not going any lower, but we're going to continue doing this for 2 years. If you want a greater and more accurate view of the ECB economic condition and what is considered to be the economic condition by its central bank, then you look at their policy. It's telling you all you need to know without examining the specific statistics, as we did on some of them. I didn't look at some of the other ones, some of the consumer sentiment numbers and the PPI numbers, but they tell you the same story about Europe, about the EMU specifically, but about Europe in general. The focus now has to shift to the United States, because even if you get better statistics out of Europe, it's not going to make any difference. There is no horizon currently in play for the ECB to turn around and do what the Fed is doing and start raising rates. So that just counts. You can get the strongest figures you want out of the ECB for the next, out of the EMU for the next 6 months, unless something incredibly out of logic and out of possibility happened. I don't know, maybe somebody came down and intervened. You're not going to get a change in ECB policy. However, the Fed policy is malleable at this point. They're not going to raise this week, but they could raise in June. They could raise in September. As the Fed likes to say, we're data dependent. Okay, we can drop that one. But so the long-term probabilities are still, in my mind, for a lower euro. The questions has switched from a lower euro caused by something the ECB does to something that the Fed does. Tomorrow's retail sales in the US. I think negative 0.2 is expected in the headline and maybe negative 0.1 in the control group, the one that goes, the retail sales number that figures into the GDP calculation. If that is a stronger than expected number, the euro should take a fairly reasonable hit for the obvious reason that this brings the Fed date for the next rate increase closer, or raises the possibilities of the Fed doing that. The Fed is not going to change its policy unless there is a very, very serious deterioration in both the world economy, which is always possible out of China. And I'm not picking on China, although it would be hard to pick on China, but it's true for many countries around the world. Vis-a-vis the US and what the US is seeing in here. I mean, it does appear, there are two factors to the US economy. The industrial portion of the US is, between 10 and 15, maybe about 12% of the US economy is in recession. There's no question about it, has been for at least 6 months. But the other 90% of the economy is not. Now, it's not growing strongly. It maybe is growing at 2%. So it's very susceptible to hits or to difficulties created outside the US and the world. And so the risk factors, if there were no outside risk factors, you would say the US probably continue to chug along at 2%. But if you're factoring risk factors, which you have to do, you have to add that in. A 2% growth has almost no margin for error as far as outside impact or internal impact as well. We can all think of events that could affect the internal US events. They're probably not economic, but they might be political. That could affect the view of US growth going forward. Okay, the last thing I want to look at. So the policy background between the US Fed and the ECB and the EMU, I think is still unchanged and will reassert itself. Okay, these are some of the technicals that we've seen. Let's just a brief technical here for the euro dollar. We had a long downtrend from the summer of 2014, had a much sharper trend from the end of 2014 down to the middle. We had a very gradual recovery through most of 2015, but once you breached and it actually goes back all the way to here, the 115 level, which is back in, where is this right here? Back in the first quarter of 2015, the euro was traded basically 10 figures between 115 and 105. Interestingly, though, not entirely, but most of the time it's either been above 110 or below 110. Not entirely, but most of the time. There's not a lot of back and forth on the 110 line. There is some here, there is a little bit here, and a trifle here, but that's it. It's either been generally above or below. The recovery that we've seen here is tapering. You are getting, it's a long-term, very nice pennant formation that is, and the one thing that's characteristic of pennant formations, which are emblematic of declining volatility, declining trading ranges, is that they break. The question is always, which side will they break to? Now, as it is set now, the Just check, let's see if we have any more questions here. Okay. Okay, so I'm gonna have to wrap up in about a minute here, Greg. Anyone? So if you have any more questions about the technicals or anything, any other aspects, please put them in, because I'm gonna have to end. I know that FX Street wants these things to end. So as it is now, I would say that the euro heads lower, both based on the fundamental factors and this technical factor we have right here. There isn't any fundamental factor to drive the euro higher. The ECB is committed to its liquidity policies, to its loosening, to its accommodative policies. And the Fed is committed to its tightening policies. The ECB has already said it's not going to change. Now, if things get a whole lot worse in the world, will the ECB do more? It probably will. But we're not looking at that problem right now. So the remaining consideration for the fundamental factor, which is why I think, at least until we have a better picture, this is headed, the euro is headed back into the cone of the pennant, the declining pennant formation. I think the euro goes lower from here. That, of course, will depend not on the ECB, but on the Fed, and on what we are seeing in U.S. statistics for the next month or two. I think the Fed would desperately, and they've shown this, want to raise rates. Sooner or later, there's going to be a U.S. recession, and the Fed does not want to be where it is with rate policy when that hits. Okay, folks, I'm going to stop now. I thank you very much for your attention. I hope this has been useful. I thank FX Street, Adinda and Mauricio for helping me to put this on. I thank Google, of course, for the new Hangout software, which is much easier to use. If anyone has any questions or comments, I will put my email address in the chat box. You can send me a comment and I'll be glad to answer it. Again, I thank you all very much, and we will do this again next Monday. Next Monday will be a fundamental topic. I haven't decided on the topic yet. It will be out on Thursday morning on the FX Street site. So I thank you very much for attending once again, and everyone have a great day. Take care.